This is Harish from 2nd BCom CA. Today I'm going to take seminar on goodwill. Come let's learn what is goodwill. Goodwill is the value or reputation of a firm in respect of profits expected in the future over and above the normal rate of profits. In simple terms, goodwill means the more number of people will come and buy your goods in future as compared to other competitors. Goodwill is an intangible asset. It cannot be seen, it cannot be felt, it cannot be transported physically, even though it is very real. The major factors affecting goodwill are listed below. I have not given the entire factors, but I have given the factors that are the most important. The quality of goods sold by the business. If you are selling better quality goods the same price in the market as compared to other competitors, more and more number of people will come and buy your own goods because you are selling this better quality at the same price. The personal reputation of the owners, that is their ability to attract customers. Let's say Deepika Padukone has started a lipstick selling business. Now, more number of people will come and buy her goods as she already has a fan base as Bollywood actress and she knows the trade in makeup industry. The location of business premises. Let's say you are starting a business in Chennai and in a remote village. The business in Chennai will get more number of customers as it is populated. The business in other village will not get as much customer or attention since it is very less dense populated. The possession of near monopoly rights. Now, monopoly rights means uh, only you can operate and business and continue business in the particular field or industry. Let's take railways. Right, in railways only the government is allowed to operate railways, so naturally it gets all the customer attention and the customers will go and approach the railways for the transportation. The presence of a very experienced management skill. Naturally, if your top management is very experienced in your field of business, they will know how to make better profits. The amount of budget allocated to the research and development department, which enables the production at low cost. So if a research and development department invents newer technologies and techniques of production to produce the better quality of goods at low cost, naturally your profits will grow because you are producing it in a cost effective way. The possession of special contracts for the availability of materials such as mining rights, etc. In Varisu film, Vijay sir's father will have the exclusive mining rights for 50 years lease. Now that is a very beneficial thing because he owns the mining rights for the 50 years and he can mine cement and granite for that. The years of experience in the particular field of business. If you are more comfortable in the field of business because of the years of experience, you will naturally know how to make better profits and deal with the customers every day. The amount of government support that the firm gets. Let's take a tobacco industry and water bottle selling industry. See, the tobacco industry will not get the government support, and government will impose more tax on the tobacco industry because it is harmful. And the water bottle selling industry will get more support from the government because it is a beneficial product for the public. The nature of goods sold by the firm. So, if you're selling necessary goods or luxury goods, more number of people will come and buy your goods since it is like salt and water are very necessary for everyday life. More number of people will buy salt as compared to, let's say, wheat. Wheat is normally not used that much in South India. It is only used for breakfast like chapatis. So more people will not buy wheat as compared to salt. Now let's see the types of goodwill. There are two types of goodwill: self-generated goodwill and purchased goodwill. Self-generated goodwill or inherent goodwill is the value of business or the fair value of net assets. Now what is fair value and what are net assets? The net asset means If you are having a 50 asset of 50 lakhs and a liability of 30 lakhs in this company, net asset means the difference of 20 lakhs with your liability and assets, and it's fair value. Now if you're selling your company, and for example, if you're selling your business and the net value of the assets is 20 lakhs and the customer is ready to pay 30 or 40 lakhs, for example, the amount that you're getting more than the net value of assets is called goodwill. Self-generated goodwill is referred as internally generated goodwill, and it occurs over some time due to the good status of the business. There is no outflow of cash since you are not purchasing the self-generated goodwill. The self-generated goodwill is not shown in the asset side of the balance sheet. Now let's go to purchase goodwill. When a company plans to purchase another company or enterprise, the consideration paid exceeds the total of the individual valuation of each of the assets and liabilities of the company or enterprise being purchased. The excess amount is known as goodwill or purchase goodwill. The excess amount is paid as premium for the goodwill. There is an outflow of cash since the amount is paid over the net value for the goodwill. The purchased goodwill will be shown in the asset side of balance sheet as an intangible asset. Now, why it is necessary to calculate or evaluate self-generated goodwill? Naturally, when there are some reasons for valuation of goodwill. When there is a change in the profit sharing ratio between the partners in a partnership firms, when the partners want to change the profit sharing ratio because some partner is not participating enough in the firm, or some partner is from some partner fairly wants more percentage of profit, the partnership ratio is changed between the partners, and goodwill value is generated and changed and given according to the partners ratio. When a partner is admitted in the partnership firm, naturally the goodwill is evaluated and changed. When there is a death or retirement of an existing partner in a partnership firm, when a firm is amalgamated with another firm or a company, when two firms internally join and form a new company, that is. Let's see how to calculate goodwill. There are four methods for calculation of goodwill, that is purchase of average profit method, purchase of weighted average profit method, super profit goodwill valuation method, capitalization of profits method. In the average profit method, the total profit of the company excluding the abnormal profits and adding the abnormal losses is calculated. Now, why we are excluding the abnormal profits? Because it is not normally generated in the normal course of business. And why we are adding the abnormal losses? Abnormal losses in the sense loss by fire or by theft. Loss by fire or theft normally doesn't happen in a company as they take more care. So total profit in total profit we remove abnormal profits and add abnormal losses. Average profit is equal to total profit upon number of years, and goodwill is calculated as average profit times the number of years of purchase. Weighted average profit method. Now let's see why we are having so many different methods. The different methods are made because of the individuality of the business and the uniqueness. If you are comparing the goodwill of some local trader and the Legend Sarana stores, the Legend Sarana stores will have more goodwill. But the normal sole trader can also have 5 lakhs profit and the same 5 lakh profit and generate 3 lakhs goodwill. And Legend Sarana can also have 5 lakhs profit and gain 3 lakhs goodwill. But the Legend Sarana has very much more goodwill in Chennai and Tamil Nadu because he's a movie star. We have to compare with weighted average profit method for Legend Sarana's goodwill, as he has increasing trend of profits. In this method, we allocate weights to the years of profit. If the profit of the last year gains 5 8, and the before gains 4, and the year before that gains 3, and the year before that gains 2, and we divide the total weighted product with the total number of weights. Goodwill is now calculated as weighted average profit multiplied by the number of years of purchase. In the case of super profit method, goodwill is valued on the basis of super profit earned by the firm. Now, super profit is naturally not all firms earn super profit, but some firms earn super profit. Super profit is the actual profit earned by the firm for the years minus the normal profit. Now, normal profit is calculated as net capital employed in the firm multiplied by the normal rate of return. Actual profit is the average maintainable profit that is given in the industry by the standards. Normal profit is equal to normal rate of return multiplied by capital employed, and goodwill is equal to super profit multiplied by the number of years of purchase. Now let's go to the capitalization method. Capitalization of average profit method. It has two methods. One is capitalization of average profit method, and the other is capitalization of super profit method. In the method of capitalization of average profit, the goodwill value will be determined by subtracting the actual capital employed from the capitalized value of the average profits on the basis of normal rate of profit return. Goodwill is equal to normal capital minus actual capital employed. Capitalized average value of goodwill is equal to average capital employed minus goodwill. Now let's see capitalization of super profit method. In this method, the goodwill valuation is determined by capitalizing the super profit on the basis of normal rate of return. The formula of capitalization of super profit method is as follows. Capitalization of super profit is equal to average of annual super profit multiplied by 100 divided by normal rate of return. Let's see an example for the capitalization method. The following illustration will help us in understanding the concept of capitalization of average profit method more clearly. Butt and Sons are able to earn a profit of 90,000 by infusing a capital of 5 lakhs. The normal rate of return is 15%, determined by the value of goodwill by using the capitalization of super profit method. Normal profit is equal to capital employed into normal rate of return divided by 100, which is 5 lakhs into 15 divided by 100, that is 75,000. So super profit is equal to average profit minus normal profit, which is 90,000 minus 75,000, it comes as 15,000. Now goodwill is equal to average of annual super profit into 100 divided by normal rate of return, that is 15,000 multiplied by 100 divided by 15, which comes as 1 lakh. Now this sums up my seminar. Thank you and have a nice day.